welcome everyone to the Federal Budget Forum. My name is Matt Burrell and thank you for joining us for the 2022-23 SW Federal Budget Forum. Today, we have a full lineup of experts to talk through last night's budget, which again will be led by Catherine Birch of the ANZ. Catherine's role today will be to provide us the ANZ's views on the themes from last night's budget. We'll then start a deeper dive into some of these specific announcements, and to help us with that are our Shine Wing industry experts that I'll introduce you to throughout this morning's session. But before I introduce you more formally to Catherine and to the rest of the lineup, please let me outline some of today's formalities. Similar to prior sessions, we've placed you all on mute so we don't get background feedback to ensure everyone can clearly hear the presentations. We have a Q&A functionality during this forum, and we very much hope that you use that. Please submit any questions that you have using the Q&A button, which is located in your Zoom menu. To the extent that your questions aren't answered throughout the presentations, we have dedicated Q&A time at the end of the presentations. We'll run a couple of polls during the course of the presentations, and I'll direct you to these as they pop up on our screens. We'll wrap up today around 10:45 to enable you all to get back to your day, at which time our website will be updated to have today's presentations and other information regarding last night's announcement. So today's presentation will begin with the big picture. We're again fortunate to have Catherine Birch with us today. Catherine is a senior economist at ANZ Research, and she leads the ANZ's Federal Budget Analysis team. She provides research, forecasts and analysis on the labour market, business and infrastructure investment, ESG and the broader Australian economy. Prior to joining ANZ, Catherine worked as a senior policy advisor for the Victorian government. Catherine provided her insights at this session last year, and we're fortunate to have her back. So Catherine, welcome. How did the ANZ team read last night's budget?
Thanks very much, Matt, and thank you everyone for having me back again this year. I might share some slides, because what is an economic presentation without some economic charts, particularly for the budget? Look, I think, as Matt said, I'll start a bit with the big picture and then talk about what our view specifically of the budget is, and then maybe finish with some key questions, particularly what is missing and how much of this budget we will actually see implemented. I think one of the things that surprised us with the budget was that the amount of spending. We'd factored in maybe 20 to 25 billion of additional spending over the next 5 years from 21-22, but that came in closer to 40 billion. And that's a lot of that spending is really focused on the near term, particularly the current financial year and the next one, with some of these one-off payments designed to assist with the increased cost of living, the cut to the fuel excise as well. There's obviously more funding going towards people in flooded areas, which of course is very important, and the key thing there is to get the money out as quickly as possible to the people that need it. And then we've got about another 6 billion to deal with the COVID response as well, while we're moving into winter, given that the risk of new variants is still significant. But while there was more spending than we had factored in, our revenue was also higher as well. And so this is the first budget since in a couple of years where we haven't seen the government spend all of the windfall gains from the better than expected economy. Last time we've seen all those benefits actually spent, whereas this time we've actually seen significant improvements across the forward estimates. So actually, if we look at the 5 years from 21-22, the cumulative deficits over that period are set to be more than $100 billion lower than they were in my EPO, which only just came out a few months ago, which is really a testament to how well the economy has recovered. So I think just focusing on the spending, particularly in the near term, I mean, the big question is, this is coming at a time where demand is already incredibly strong. We have seen a lot of inflation already, and we're expecting that inflation will get close to 5% by the middle of the year. The risk is it could get higher. And our estimates are higher than what the budget had in the forecast there. So there is that risk. But as I said, deficits are likely to be significantly lower. We're expecting to see by 25-26 a deficit of around 43.1 billion, which is down from the 79.8 billion estimated for the current year. While generally you would look at shrinking deficits as a sign of contractionary policy, it's still, in our view, if you look at it in level terms, quite an expansionary, settings. We've still got a deficit of around 3.5% of GDP estimated for this year, at a time where we have an unemployment rate of 4%, and it's set to get a lot lower. In Treasury's forecast, they're expecting the unemployment rate to get to 3.75% by Q3 this year and stay there for a few years. We're actually even more optimistic than think we'll see an unemployment rate in the low threes. But the concern is, if we look at the medium-term projections as well, there is no surplus expected within the next decade. So while there has been a little bit of talk about a fiscal strategy and focusing on fiscal repair, there's not so much talk about getting back to balance or getting back into surplus anymore. The government's focus does seem to have shifted to getting that share of debt to GDP down lower. And one way you can do that is by growing the economy more quickly. This is particularly important, I think, to actually try and get that debt to GDP ratio down, to actually try and get back to surplus at some stage, not immediately, but at some stage. Because we've seen during the pandemic how critical it was that we had that ability to spend to support the economy through this massive shock that we had, and to get us back into what's a pretty good economic position, all things considered now. So that is something we will be watching. We do think there's upside risks, though, to the fiscal position. By that I mean we are expecting to see even smaller deficits over the next few years. And there's a few reasons for that. Largely, some of the Treasury's economic forecasts do seem a bit conservative to us. As we all know, they have their assumptions on commodity prices, and commodity prices have been a big contributor to the additional revenue gains over the past couple of years. So some assumptions include iron ore prices going from $134 a tonne to 55, thermal coal to go from 320 to 60 per tonne, metallurgical coal to go from 512 to 130. So they're all significant assumptions that do mean we could see deficits reduced by tens of billions of dollars going forward if commodity prices do stay quite elevated. The other thing is that, some of the economic forecasts, again, we're more optimistic than what the Treasury has factored in. So as I said, we're expecting an unemployment rate of around 3.3% by the end of this year, which would be the lowest since the mid-70s. So that has two channels that it affects the fiscal position. One is that it means there'll be more people in employment, so more people paying income tax. The other is there will be fewer people that need to, that will be relying on welfare payments, for example. So that reduces the payment side of the equation. So that does mean that we could see, again, that risk or potential benefit that we see smaller deficits than expected. One of the concerns in the budget, though, certainly the cost of living, and we are seeing inflation increasing. If we look at our weekly ANZ Roy Morgan Consumer Confidence Survey, inflation expectations hit 6.4% on the latest weekend. And that's the highest we've seen essentially since the GFC, when we did see inflation at around 5%. That is cutting into the cost of living, and there were obviously measures in the budget to try to address that, including the fuel excise. One thing we have to remember is that, yes, cutting that fuel excise in half, so reducing it by 22.1 cents, means that inflation, or headline inflation at least, will be a bit lower, marginally lower than it would have been otherwise in Q2 and Q3 this year. But if it does come to an end after the 6 months, as planned, it means that inflation in Q4 will be higher. So we have got to account for what happens when that policy does end as well. One of the big differences that we'll see over the next year, and we're already starting to see, is the return of net overseas migration. And as you can see, Treasury forecasting that population growth will increase quite rapidly over the next year, but will still be below the growth that we were seeing before the pandemic. But something that we agree with Treasury on, and this is often a question that I get when we talk about our positive labour market outlook, is what does the reopening of borders mean for the labour market, for unemployment? And we agree with Treasury in that we don't see it preventing further labour market tightening or preventing wage growth acceleration. It will take a while for population growth to pick up again. We think a lot of the tightening in the labour market so far has been demand driven, so the supply side has really acted to accelerate it rather than driving it. And also when new people arrive, whether it's skilled migrants, whether it's students, whether it's backpackers, yes, they will add to the supply of workers. They're also going to add to what's already a very strong demand side because they need to buy their own goods and services. They have housing demand as well. So that's why we are still quite positive about the labour market. So what does this mean for net debt overall? Because the deficits have been materially reduced, that does mean that net debt is forecast to rise more slowly and peak at a lower point than in my eco, again, just a few months ago. And as a share of GDP, remember, if we're thinking about this focus of the debt to GDP ratio, because again, we've got these better economic growth forecasts, that means that that's going to, again, even pick up more slowly and peak at a lower point. However, net debt for 21-22 estimated at 27.6%. That's still going to rise to an estimated 33.1% by the middle of the decade. Yes, it's lower than it was in my eco and much lower than in the previous budget, but it will still be an all-time high. So I think we've also got to think about what the debt servicing looks like as well. And this is an interesting one because we saw in the budget that the estimates on interest costs payable on this debt is pretty much unchanged on what was in my eco, particularly as a share of GDP. But to us, the interest rate assumptions seem a bit low. We have seen bond yields really pick up quite significant recently. Obviously, a lot of volatility in the market at the moment, but it does look like we're going into what could be a pretty fast-paced rate tightening cycle, not only here, but overseas as well. So because these assumptions seem a bit low in our view, the risk is that interest costs come in higher than they are forecast. I'll just finish up with a couple of thoughts. We've gone through the macro level view, we've gone through what our view is versus what we actually saw in the budget. So I think there's two key questions still to cover. One, will this budget actually be implemented? We have an election coming up in May. A lot of this budget does seem to be focused quite a bit on the next 6 weeks in particular. But how much actually gets done, whether we have a change of government or whether the government is re-elected and they decide that we have to, shift the strategy, whether it's more on fiscal repair when they're not trying to, get votes for an election in the very short term. That will be something to watch. Particularly as I said, we've got no surplus forecast in the next decade. But soon we're going to run into a tax to GDP cap, and that means that something will need to be done, particularly on the payments side. I think the second big question is what's missing in the budget. in my view, quite a bit. But I think in a nutshell, if I have to say it in one sentence, there was not much to improve the productive capacity of the economy. And that's really important because a lot of this, the payments in this one and what we've seen over the pandemic has been very near-term focused. And during the pandemic, that is incredibly important. But we can't just bank on the economy outpacing our expectations on a sustainable basis. It just doesn't happen. So we need to think about what we do in the medium term. And to do that, well, yes, we'll have population growth picking up, and that's a key driver of economic activity. But we need to focus on productivity and on participation as well. On participation, I think the big thing that was missing was really the, anything on childcare. And that looks like it could be a vulnerability for the coalition leading up to the election, particularly given that Labor is pitching their childcare policy as an economic measure. So improved support for childcare frees up more parents, particularly mothers, to get back into work, increases participation, contributes more to the economy. We've also, seen some pretty underwhelming, I think, results on aged care, particularly following the Royal Commission that we saw. We had net zero committed to at the end of last year, and yet nothing on climate change really. And that again could be a bit of a weak point. Labor certainly have policies, a larger emissions reduction target by 2030, also plans to further invest in transmission infrastructure and some of these things to help encourage more renewable energy generation and investment. While the states are really doing a lot of that already, we've got renewable energy zones in planning in Queensland, New South Wales and Victoria. But one of the big challenges for the sector has been that disconnect between federal and state policy. So aligning federal policy on energy more closely with state policy should provide more certainty for the private sector. And just finally, we saw almost $18 billion committed to infrastructure in the budget as well. Look, I think that's really an old way of doing things. We already have a very, very large infrastructure pipeline coming up. We are not going to be able to realise that pipeline. We've got capacity constraints. There is so many large-scale complex projects that are planned to get underway all at once. Adding more to that pipeline, I think, is counterproductive. I'll leave it there and pass back to Matt. Thank you.
Thanks, Catherine. That was a great oversight. We're going to come back to you shortly to answer some questions that are already flowing in. So for those that have questions, please use the Q&A functionality. Catherine will be answering those at the end of today's sessions, pending any further IT issues at my end. Before we get into the industry presentations, we're going to start with our first poll, which will be on your screens in a minute. I'm hoping if we give that a moment, here we go. Has the budget delivered what you were after? Yes, no, on the fence, in part. So please answer that and we'll provide the results, if not at the end of today's sessions, then on our website. So we're now going to turn to some industry and sector specific issues, and to help us dissect last night's budget, I'll call on a number of my SW colleagues from around the country. First up is Matt Oakey and Chris Dexter, partners in our business, practice and corporate advisory group, to talk through last night's announcements that impact the SME and individual sectors of the market. Now, over the last couple of years, there's been some pretty good news coming out for this sector. Matt and Chris, how did we do last night?
Thanks, Matt. Good morning, everyone. So I'm going to talk about individuals and then hand over to Chris Dexter to talk about small business. Two of the headline items that came out of the budget were to do with cost of living. Obviously, with inflationary pressures, currently the government is looking to assist lower and middle income families and individuals with the cost of living. So there was two announcements that came out of that. The first was they're going to increase the lower and middle income tax offset. So taxpayers earning less than $126,000 a year will be eligible for the increase. Currently, the offset ranges between $255 and $1,080, and they have now increased that range from between $675 and $1,500. Now, this will be available to taxpayers when they lodge their 2022 tax return. So we're likely to see a lot of taxpayers lodge their returns early this year, like last year. One thing to note is that this particular measure hasn't been extended to the 2023 income year. So this is the last year that will be available. It's estimated to cost the budget bottom line $4.1 billion. The second one was a $250 cost of living payment. And that is eligible recipients are those that receive certain government payments and concession card holders, such as the age pension, disability support pensions, carers allowances and payments, along with job seeker and youth allowance and a number of others. This payment is estimated to go out to these people in April of this financial year. Again, the cost of this to the budget is $1.5 billion. So if you look at those two measures, there's $5.6 billion as what a lot of people are terming an election sweetener. So they're quite temporary measures. I might talk briefly about the Medicare levy low-income threshold increases. They're increasing from the 1st July 2021, so the current income year. The increases range from $100 to $400 in the thresholds. So it's not a significant measure, and it's estimated to cost $90 million over the forward estimates. Paid parental leave. So there's been enhancements to the paid parental leave scheme, and what they're doing is rolling the dad and partner pay into the paid parental leave scheme to create a single scheme. Of up to 20 weeks, which is shareable between our eligible working parents as they see fit. So previously, it was 18 weeks to the primary carer and then 2 weeks to the other person. Now there's some flexibility in that, and the leave can be taken any time within 2 years of the birth or adoption of the child, and the income tests are going to be broadened for this particular measure. For those that are in pension mode in superannuation, there is an extension to the temporary reduction in superannuation drawdowns. So as you may be aware that you only need to draw down 50% of what is legislated, and that's going to continue on through to 30 June 2023. So if you don't need to use all the money or all the pension money out of your super fund, you can leave some of it in there to continue to accumulate wealth. The final measure that will impact on individuals is the tax deductibility of COVID-19 tests. So if you're required to take a COVID-19 test to attend a workplace, it will be tax deductible from the 1st of July 2021. So I'm not sure if you've already done it, how you're going to substantiate it if you haven't kept receipts, but we'll have to work through that. The government are also ensuring that if it is a business that pays for that test, that there will not be any FBT on those expenses where you're providing them to an employee. So overall, there's some things in the budgets for individual, mainly around the cost of living and those temporary measures, but otherwise not a lot of changes there for individuals. So I'd like to now hand over to Chris Dexter, who'll talk about small business.
Thanks very much, Matt. So as Matt Bill mentioned in the introduction, certainly in previous budgets, there was a bit for small businesses, not probably quite as much this time round. The two most significant changes are the two that are mentioned on the first two dot points there. So the first one's in relation to skills and training boost, and this really is an additional 20% tax deduction for businesses that spend money on third-party providers to train their staff. And so it's relevant for businesses with a turnover of $50 million or more, or less, sorry. And relevant expenditure from budget night last night to 30 June 2024. So a few caveats like always, the relevant training provider needs to be based in Australia, and equally the employees need to be based in Australia as well as or conducted online. So one slight quirk in the rules is for the eligible expenditure for the 2022 financial year, the boost component, you only get the benefit of that deduction in the 2023 return. So there's nothing actually really bonus available in the 2022 financial year itself. So similar sort of provision is in relation to what they call digital adoption related items. That's technology investment boost. So same sort of general premise, where eligible expenditure on digital adoption items for businesses with a turnover of 50 million or less, with expenditure being incurred from budget night last night to 30 June 2023. So again, you get a 20% additional deduction on the eligible expenditure. With this time round though, there is a cap of $100,000 for each income year on expenditure that you can claim the boost amount for. And so again, 2022 financial year related expenditure, you can only get the tax benefit of the boost when you lodge your 2023 income tax return. So then the next measure has been pre-flagged prior to the budget. That's in relation to changes to the uplift factor being applied to PAYG instalments. So this is both income tax and GST. So for the 2023 financial year, the uplift factor is going to be capped at 2%, where it otherwise would have been up at 10%. So this measure really is just in relation to cash flow support in the short term for businesses. There's no actual permanent benefit, but it will provide potentially some cash flow relief in the next sort of 12 to 18 months. The fourth dot point is just really an expansion of earlier budgets. So in earlier budgets, some of the COVID-19 related grants and relief were given non-assessable, non-exempt status. And in the budget last night, there was a further 8 state-based measures that were given that same characterisation for the 2022 financial year. 5 of them were in New South Wales, 2 of them were in South Australia, and 1 in Queensland. So if you have received any of those sorts of payments during the 2022 financial year, it's worth checking to see if they're on that list to be non-assessable, non-exempt. And last but not least is just in relation to employee share schemes. So certainly not the sweeping reforms that some people had spoken about, anticipated and hoped, but there was a small change in relation to unlisted companies, increasing the threshold for participants to enable them to participate up to $30,000 each financial year, which is up from $5,000 previously. So again, that may mean for some businesses that it's worth revisiting employee share schemes given the increase in thresholds. But as I say, certainly not the sweeping reforms that some had hoped for. Thanks very much for that, Matt.
Thanks, Chris and Matt. We'll turn next to the education sector, which has been an industry more heavily impacted than most by the pandemic. And to guide us through the budget's impact is one of our senior partners, Steve Allen. Steve?
Thanks, Matt. Yeah, look, well, from an education perspective, the budget followed previous budgets in that there was very little funding for universities, vocational providers or schools. The theme of government remains around funding health initiatives, aged care, regional areas and skill shortages. So I'll now work through the budget measures and how they affected universities, vocational providers and schools. In regard to universities, there was little in the way of direct funding, as I mentioned. The objective of the federal budget was to try and open the borders. The government believed that the best way to fund universities is to get international students back on the ground in Australia. And as a result of that, they put all their effort in the last 12 months to try and open the borders. They did provide some previously announced concessions around visas, where they reduced the cost of visas, and also extended work rights for international students. So I guess in summary, the government felt that they didn't need to give the universities funding because they actually, as borders opened, the international student cohort would then fund the universities. Where they have provided funding, like direct cash funding, is around commercialisation and collaboration activities of universities. In this case, they've allocated roughly $750 million to a number of different funds where universities and academics can apply for grants between $500,000 to $5 million to get intellectual property out of universities into the commercial world. The government's always believed that universities have got a large amount of intellectual property locked in universities and that they need to get that more commercialised and get some funding from that. A large, as you can see, $750 million of funding to CSIRO, new research training pathways, and the accelerator grants is for that. In addition, the federal government also has over many years funded two very large funds called the Medical Research Future Fund and also a Biomedical Fund. And they put billions of dollars into those over prior years. And again, they've topped that up with another $1.3 billion in this year's budget to expand grants from medical institutes and universities. As you can see, the funding from government is all around COVID and health initiatives. There's not a lot of other funding for other education activities. So it's all around health, COVID, and those sorts of outcomes. The last bit of funding that they've announced is in regard to an mRNA vaccine manufacturing facility. As we're all aware, there was some vaccines developed in Victoria here where not CSIRO, one of the providers here was developing the vaccine, the AstraZeneca's vaccine. The government has now said that they want to build their own facility, which is government owned. It's going to allow for vaccine manufacturing to occur in Victoria. They haven't announced how much funding is going to be for that because it will be significant, but that's likely to involve collaborations of universities and medical institutes across Victoria in developing that particular facility. We move on now to vocational education. Typically, vocational education is funded by the state government, and the federal government really just provides the additional funding to try and fill the skill shortages and develop a national scheme. So that theme has continued this year, where they've announced the closing of the Boosting Apprenticeship Commencement Scheme, which was an old scheme that's going to finish up at 30 June 22. It was a very successful scheme, which funded, it sort of gave a $5,000 cash handout to apprentices and also gave a $15,000 cash rebate to employers that employed apprentices. That scheme is coming to an end at 30 June 22. They're replacing that scheme with a new scheme. The new scheme is not as generous as the old scheme, and they're really looking at skill shortages. So the old scheme gave funding to pretty much all apprentices, where the new scheme is going to be about priority apprentices. So it could be, so the government will pick those areas of priority, and then employers and apprentices will get different levels of funding based on those areas of priority. The government has also provided $3.7 billion to further develop a national skills agreement. The lack of cohesiveness across Australia of vocational education has meant that the federal government has had to fund programs at the federal level to try and bring that all together as one single system. And as you can see, that appears to be a very expensive operation to try and achieve that. The last bit of funding for vocational is around aged care. Everyone understands the shortage of aged care workers at the moment due to COVID. And what they're looking to do there is they're looking to fund an additional $50 million for aged care places. Essential students who enrol in aged care courses won't have to pay for that course. The government will pay for that course as an incentive to try and get people to do it and then roll into aged care facilities for work. The final funding initiatives indirectly is around, they've allocated $10 billion. This is a new sort of area. They've allocated $10 billion to a very interesting name called Red Spice. Red Spice is the Australian Signals Directorate in Canberra. That's a cybersecurity type hub that is being created to try and combat other international activities in the cybersecurity space. That's going to obviously fund 2,000 new jobs they've indicated, and the universities and vocational providers just don't provide enough graduates in those particular spaces. So we expect that over the next couple of years, universities and vocational providers will have to increase their intake in those areas to allocate those jobs. But look, in summary, the education sector has come to expect very little from the federal government over recent years, and really 2022 continued that particular trend. All the funding was for health initiatives, very little funding directly to schools, vocational providers, or universities, and we expect that to continue over the next couple of years. Back to you, Matt.
Thank you, Steve. So next up is another sector hit hard by the closed borders, which is the tourism, hospitality and gaming sector. And to take us through this market segment is our lead partner based out of our Brisbane office, Jeremy Wick. Jeremy?
Thanks, Matt. I suppose to sum up our reaction in relation to the budget, it really is the glass is half empty. For a sector hit hard, as Matt said, by the COVID and international border closures, we see that the cost of living release announced in the budget will not go far enough to stimulate discretionary spending into hospitality and tourism. The Skilled Apprenticeship Support Scheme is a phase out of the old scheme and an implementation of a new one with as yet unannounced priority areas. So we look forward to seeing if hospitality and tourism is one of those priority areas for apprenticeships. There were several announcements in the budget supporting the recovery of the tourism sector. Much of the expenditure, however, was redirected funding already taken up by Austrade and the Australian Tourism. There was $146 million announced to support the recovery of the tourism sector, of which included extension of the COVID-19 Consumer Travel Support Program to help travel agents and tour arrangers through this period. $63 million over 3 years to accelerate international tourists and backpacker arrivals through targeted marketing initiatives, and $6.8 million to increase the data availability and analysis to improve planning in the tourism sector to establish an employment platform. In addition, there was extending fee relief from the Great Barrier Reef Marine Park Authority for tourism operators to assist them to attract more tourists back to the Great Barrier Reef. However, there was a real lack of incentives to attract foreign skilled migrants, which have been the backbone of the hospitality industry workforce. So we see that as a continuing issue for the industry. We did like the technology investment boost, which was an additional 20% tax deduction in relation to businesses getting digital ready, which we see there'll be some opportunities for the industry to grasp there. And as well, the skills and training boost is welcome for small businesses in the hospitality and tourism area. But again, as Chris Dexter pointed out earlier on, most of that tax deductibility boost will be limited to 2023 returns. So overall, a disappointing result from the industry's point of view. Very little in targeted support towards an industry that's already suffering severe staff shortages and no incentive to really stimulate the discretionary spending to get the industry back on track. Thanks, Matt.
Thanks, Jeremy. Well, the ag sector was a segment of the market that was involved in some interesting announcements both last night and during the week. Jade Brinkat, who leads our Sydney Agribusiness Group, is going to take us through what they all mean. Jay.
Yeah, thanks, Matt. As you say, agribusiness, I think, was one of the winners out of the budget this year. The government signals some clear support for our regions and agribusiness in general. We've seen a range of kind of new packages and new investment coming out of the government, some of the most notable being $2 billion flagged in a regional accelerator program to cover kind of a range of areas, including manufacturing, infrastructure, skills and training, R&D. Some notable components being $200 million flagged for supply chain resilience, additional $100 million into the export market development grant, and a range of investment into regional manufacturing and educational infrastructure. Another new part to note, the government is expanding the patent box regime announced last year to cover practical technology-focused innovations in agriculture. It's somewhat narrow in its definition on reading. It talks specifically around what they call ag vet, so veterinary chemical products and plant breeder rights, but it's still nice to see the government kind of flagging innovation in agriculture. The government has set aside $6 billion for disaster relief funding from the recent floods in Queensland and New South Wales, including $2.2 billion for household income support and temporary accommodation, as well as a range of support for farmers, businesses needing repairs, new equipment, and some other kind of income generating support to get back on their feet. A big item that we picked up on, and it's definitely one that should be celebrated by the regions, is the improvements to regional digital connectivity. The government has flagged over $800 million of new investment, covering everything from improved mobile phone coverage around regional roads and adjacent premises, improved affordability, improved access for Indigenous communities, and an additional $480 million to improve NBN Co's fixed wireless network for regional Australia. In terms of tax changes and benefits, many of them have been covered in the previous slides, but a couple kind of to note: the reduction in the fuel excise that is really designed more for kind of mum and dad home motor users will have some benefit for the industry. On our calculation, there should be roughly a 4 cent per litre benefit for supply chain and logistics providers using kind of diesel trucks on road. We also note there's an adjustment to the calculation of primary production income for the sale of Australian carbon credit units and biodiversity certificates from on-farm activities, and also a change in the taxing point to treat them as taxed in the year that they're sold for eligible primary producers. Some of the other packages that were announced, forestry and fishing are getting quite a lot of support over the next 5 years with the establishment of new plantations, improvements to long-term sustainability for the southeast trawl fisheries, and improvements to illegal logging traceability and timber identification. We were somewhat amused and excited to see an announcement specifically for the Queen's trees. There's $20 million has been flagged to fund community-led tree planting projects to mark Her Majesty's Platinum Jubilee. There's quite a lot of rhetoric in the budget and in the kind of supporting materials around the Ag 2030, which was announced in previous years, with further support being put into that drive to build agriculture in Australia to a $100 billion industry by 2030. Including $6.5 million flagged for the Ag Move program, trying to bring workers out into the regions to support the agribusiness industry. As mentioned in some of the other slides, changes to the kind of holiday working visa caps, increasing the limits by 30%, which equates to roughly another 11,000 places available for transient workforce. And also investment in kind of support around the industry, like agricultural trade events, biosecurity, particularly around Japanese encephalitis, and kind of further support for programs like EMDG. And last but definitely not least, we saw a lot of further support coming through for water projects and infrastructure, including the Murray-Darling Basin project, on-farm emergency water infrastructure rebates, and significant infrastructure development around dams, being the Hell's Gate Dam and Paradise Dams, to improve Australia's water conservation and water capacity. So all in all, our view, while there probably could have still been more done specifically for the kind of really driving needs of the agriculture industry at the moment around immediate needs for transient workforce and increased cost of inputs, it's not a bad budget for the regions. It's definitely significant investment from the government trying to build out capability and support for regional Australia. So we gave it a kind of a 3 out of 5. Thanks a lot, Matt.
Thanks, Jay. So the results of the poll are in, and 5% of people are happy that the budget delivered what they were after. 31% no, 28% in part, and 36% are still making up their minds. So next up, we have a colleague of mine from our Melbourne office, Blaney Morgan. Blaney leads our energy and resources group, so it makes sense that he'll take us through last night's budget impact on the E&R sector. Over to you, Blaney.
Thanks, Matt. As Catherine mentioned earlier, there is some upside built in, well, I believe it'll be upside built into the budget, especially in relation to the price forecasts that energy and resources are used. If the prices hold until September before declining to March 2023, it would lead to an increase in tax receipts of almost $30 billion. And I think that's really an upside for whoever wins the next election for spending or budget repair in the next year. Some of the specific items that we noted were there's going to be continuing funding for energy and emissions reduction of $446 million over 5 years, and that's for investment in low emissions technology, including hydrogen, and it's bringing in things like a guarantee of origin scheme, community microgrid projects and gas infrastructure projects, and that's really a continuation from previous budgets. There is expected to be decreases in climate spending, so they're expecting a 35% fall over four years. Much of this drop is expected to be a cut in the purchase of carbon credits from the private sector. Then looking at critical minerals, there's continuing to be funded of $200 million over 5 years for grants to assist critical minerals producers. And there's also $50.5 million over 3 years to establish a critical minerals research and development centre, which I think is going to be based in Melbourne. There is a decrease in the fuel excise, but we think it's unlikely to impact the sector as it's not going to impact long-term demand, and most fuel excise is being rebated. There are also measures for the Australian government to release crude oil stocks from the US Strategic Oil Reserve. There's also going to be some funding to revamp environmental laws, which is kind of what Catherine's pointing towards, improvements in our productive capacity. And some of the other items which have been talked about earlier were regional infrastructure, the $21 billion committed, which Jay talked about earlier for transport, water and communications, should improve access to regional areas and include support for LNG and hydrogen production in Darwin and low emission steel production in the Pilbara. And also, as noted by Steve, the skills spending, while less than what was there previously, will have an impact in improving skills for E&R, and that's most of the items. Matt, we gave it a 3 out of 5. There are some measures, but there's more to be done.
Thank you, Blaney. Just a reminder that our Q&A segment is coming up. So there are some questions that have come through. So please, if you have a burning question that you would like to ask Catherine or any one of the team, please submit that now. So last up, we have property and infrastructure. And yes, there were the usual infrastructure spend headlines, some large projects announced, or at least officially funded. But all in all, a little disappointing for the combined sector. Some key takeaways for this sector, there's $1.3 billion for new apprentices in priority occupations and subsidies for employers. Of course, that's welcomed, and that's been mentioned by a couple of the presenters today. There's no news yet on what is a priority occupation, but it would be expected that that would be in-demand trades, which should be beneficial to the construction industry. There's an expansion of the home guarantee scheme, which of course is also welcomed. This scheme effectively guarantees a component of a housing deposit to enable certain cohorts to be able to afford housing and not to pay mortgage insurance. So doubling the scheme should bring forward demand for housing, and guaranteeing an additional $2 billion of NIFIC loans to social and affordable housing providers should boost housing projects in that subsector of the market. But that was effectively it for the property sector. As I said in the introduction, there were the usual announcements of road, rail and water infrastructure projects. And these are mostly important national projects and add to our strong pipeline of large projects, but will mostly benefit the larger end of the market. It's always interesting to see which states receive the funding, and you can see from the pie graph there that it's not too unevenly spread. Interestingly, most of the Victorian projects are heavy rail projects. The key challenges for the construction industry are material and labour supply shortages, and we saw little in this budget to assist participants with those key challenges. So for the property industry, a 2 out of 5 was the best we could give, whilst infrastructure did marginally better with a 3. So that brings us to the end of the formal presentations. Before we get to our Q&A segment, we have time for one more poll, which has just popped up on our screens now. And the question is, do you think, based on this budget, that the Morrison government will be successful at the upcoming election? i.e., will they get back in, yes or no? So we'll give you a little bit of time to consider that one. So it's now time to ask the panel a couple of questions that have been asked throughout the presentations. And I'm just going to my Q&A segment now. Catherine, there are a couple here for you, I reckon. So you might be doing some of the heavy lifting early. Could I please have your thoughts on the RBA interest rate projections over the next 12 to 18 months?
Sure. So, look, we don't think the budget is going to be a game changer for the RBA, even though, as I said, we've got quite a bit of additional spending in the near term during a very strong demand environment with inflation rising. But it could have an effect at the margin. Our current forecasts are for the cash rate to start lifting in September, but the probability of earlier rate hikes has certainly increased. So expecting September, that will really be predicated on the wage data in particular, because the RBA wants to be sure that once these supply chain disruptions, you know, some of the effects that we're seeing on commodity prices due to the conflict in Ukraine at the moment, wants to see that once these events sort of start to wane, that they'll still see inflation within the target band. From September, we're expecting to see the cash rate at 0.75% by the end of this year, 2% by the end of next year. And we're actually expecting to see a peak in this cycle of 3% or more, which is a bit higher than what a lot of other economists are expecting.
Thanks, Catherine. Another one that's come through in a couple of iterations. What did the budget assume about population growth, migration, foreign students, and how might this impact the numbers?
So the budget is expecting that population growth will pick up. It won't get back quite to where it was before the pandemic by 23-24, But we'll see, I think based on their estimates of net overseas migration, we'll see net overseas migration above 200,000 again by 23-24. So not far off what we were seeing before the pandemic. What does that mean to the budget? Look, it is certainly a benefit on the revenue side. A lot of people who do come are skilled migrants. They will be contributing through taxation revenue. They will be contributing through productivity, particularly if we get a lot of people who are highly skilled, highly experienced that we can match to some of the vacant roles at the moment. But we also have to consider that, again, it's not just the supply side, it is the demand side as well. So particularly if we're thinking about things like education, which, as mentioned, hasn't really got much love in the past few budgets. If we think about health, if we think about traffic and that sort of thing too, we do have to think about that side as well. But return of population growth will certainly be a key economic driver.
Thanks, Catherine. This one is probably also directed at you, but the other team members might be able to assist. How do we even get close to net zero without serious effort, contribution from the federal government to address?
Very good question. There's going to need to be a lot more that needs to be done, and the longer we leave it, the harder it is going to be. And we're already seeing it with this global energy transition and the volatility. Even without the Ukraine conflict, we were expecting a very volatile period, into the medium to longer term for commodity prices, because supply and investment isn't responding to price signals as much as they would in the past because of these longer term asset risks. So we really do need to be investing more into that capacity for renewable energy generation. What could the government do that doesn't see them shelling out money? You could cut subsidies for fossil fuels. They could also introduce a carbon tax, but can't see that happening from either party given our experience earlier last decade.
Thanks, Catherine. This one is for Steve Allen. Will universities benefit from the additional 20% deduction to retrain employees?
Universities, well, I guess from the university's perspective in the last couple of years, they've really done a major employment rationalisation to get that. But from a tax perspective, that's a tax deduction, I think, from memory. So you get an additional deduction. Because universities are tax exempt, anything to do with tax doesn't necessarily help a university. So they won't directly impact, they won't directly benefit in any way from that particular incentive on the basis that they're already income tax exempt. So yeah, so they're definitely doing a lot of retraining, but they won't be getting any benefit from it from a tax perspective because they're tax exempt.
Thanks, Steve. This one is sent to everybody. If you had the ideal budget strategy at the moment, what would it be? Tricky one, I guess, to answer. Catherine, maybe you can begin trying to unpick that question by talking about what you maybe would have liked to have seen compared to what we did see.
Look, there's many things that I would like to see in the budget that we didn't, but a few things that come to mind. I already spoke a bit about childcare, and the caring economy in particular is really important. If we see more support on that side, that will lift participation, which will contribute to economic growth. Again, on the climate change side, and really I've already covered that with the previous questioner. So look, on the payment side, there are certainly other areas that I would have focused on. On the revenue side, look, I think the key thing will be that we need significant tax reform. We've had, a number of shiny reports telling us what we should be doing, including the Henry Review several years ago, but not much has really been done. So we need to look at making sure that our tax base is broad, is incentivising and disincentivising the right things, and is more sustainable going into the future as well.
Do any other panelists have a view on what they would have liked to have seen?
Yeah, Matt, I think I'll just mirror kind of Catherine's last comment there. The lack of appetite for tax reform, while not particularly surprising in an election year, is kind of a bit sad. We've kind of seen 3 kind of consecutive budgets where it's just been all but ignored. So I think it should be one that's starting to come back on the government agenda, and hopefully will be after the election gets settled later in the year.
So while I might be a little bit on the optimistic side, I was probably also looking or hoping for some of the temporary COVID measures to maybe sort of enshrine on a more permanent basis. And so maybe I am 1 year early on that, but the loss carryback, the temporary full expensing, those sorts of measures maybe being a bit more of a permanent feature, but we do have 1 more year for those to run. So maybe that's next year, notwithstanding that probably the budget backdrop isn't necessarily very supportive of it.
Thanks, Chris. Catherine, here's one on the housing market. So how do you think the budget will impact the current housing market? Won't the new announcements just increase demand and be passed on?
Look, I think, sorry, Matt.
No, please go on.
Look, again, pretty marginal effect, but as the questioner has said, it will be sort of adding to the demand side without much to really address the supply side issues. Look, again, we've got another pretty new shiny report on housing affordability that Jason Polinsky was actually leading, which was just published a couple of weeks ago. Again, the big test, we know there are a lot of issues in the housing market. We know that affordability is really difficult and has only gotten more difficult over the past couple of years. We also know that riskier debt is continuing to rise as well. So we may have to see macroprudential tightening on that side because we don't want to risk financial stability. Again, the big question is someone going to step up and make the hard decisions that may be unpopular in the near term, but means that in the longer term, we're in a better position, it's more equitable. We hopefully don't see a boom bust sort of scenario in the housing market.
So a question on wage growth. I hear the opposition regularly talking about achieving significant wage growth. How do you envisage this occurring? And even in the budget numbers last night, there was an assumption around wage growth. Catherine, how does this happen, given we haven't seen it in the past?
Look, we're actually even more optimistic on wage growth than the budget forecast shows. So we're expecting to see wage growth get close to 3.5% by the end of this year, which would be a very sharp acceleration. There's a few reasons we think that. We do have a very tight labour market. We think it's going to get even tighter. And importantly, it's not just unemployment, it's also underemployment as well. And underemployment has had a much stronger relationship with wage growth over the past several years in Australia than unemployment has had. We're also seeing more and more people planning to change jobs in the next year. Job changing rate also has a positive effect on wage growth. Difficulty finding labour is still elevated, very much so. And as I said, I don't think the reopening of international borders is going to magically solve businesses' skill shortages. So there will need to be more competition on wages. And then finally, we're seeing inflation expectations rise very quickly now. And they have quite a strong relationship with wage growth. And it works in two ways. One, households going, look, the cost of living is going up. I need to ask for a higher salary, or I need to go find a better paying job to at least maintain my purchasing power. And the other way is if businesses see people expecting higher prices, maybe feeling more like they can pass on cost increases to customers without losing market share, and perhaps passing some of that increased revenue onto their workers too. So we do have a fairly positive outlook for wage growth. Finally, hopefully it materialises.
And Catherine, I guess leading on from that question, given your assumptions around wage growth, do you see inflation to be a problem? Or given wage growth might be more than inflation, do you think that's okay?
Well, at the moment, inflation is certainly outpacing wage growth. So real wages are actually falling. Household purchasing power is falling based on their income. We're expecting inflation will get close to 5% by mid-year, which would be the highest since just before the GFC when we had the mining boom as well. And the risk is that it does get higher. I mean, fuel excise is only going to have a marginal, fuel excise cut will only have a marginal impact. We're expecting real wages will continue to fall for much of this year before starting to pick up in 2023. And while we have inflation coming back from the second half of this year, hopefully some of the supply chain disruptions ease, hopefully we see commodity prices come back, and hopefully the conflict in Ukraine isn't too protracted. We do see inflation easing, but we still think that trimmed mean inflation will be around or just above the top of the RBA's target band of 2 to 3% by the end of next year, even with rates rising based on our assumptions. And that suggests that we will need to see further rate rises following that.
Thank you. So the results of the second poll are in. Do you think, based on this budget, the Morrison government will be successful at the upcoming election? 17% said yes, 45% said no, and 38% are in the middle. So still could go either way based on those results. Perhaps just one final question relating to China. And if China pulls out of the large export deals they have with all of our commodities, would the Australian economy still be sound, or is it a new world at that point in time?
Look, China needs us for a lot of things as well. We do forget that, particularly our iron ore. Incredibly important to them. There's no way they can get, replace that with iron ore supply from anywhere else. But, as we've seen over the past couple of years, we have seen some interventions in trade. Has it really put much of a dent in Australia's trade? No, not really. If we think about coal, if we think about barley and some of those exports that were targeted, for a lot of these exports, it's really a net zero what happens is that China says, no, we're not going to take it from Australia anymore. We're going to get it from country A. And then country B goes, well, hang on, I was getting, my barley or my coal from country A. Where am I going to get it now? And then they go, well, Australia is sitting over here with a bunch sitting on ships ready to go out. So really, it hasn't had that much of an effect. On the services side, probably more of a risk, but we haven't seen any signs, including things like international online university enrolments from China. We haven't really seen much of that affected. The bigger issue, I think, will be if we see a sustained slowdown in China's economic growth and how that affects Australia's economy over the medium to longer term.
Blaney, I know that you have a lot to do with the resource sector in China and Australia. Do you have any views on the likelihood of that occurring?
I think Catherine's comment's very right in that these are commodity markets, and if you shut one down, then it'll move to another effectively. There is a big risk with iron ore, but the risk is more that the Chinese economy would slow down rather than them stop buying from us. So I echo what Catherine's really saying about that. Yeah.
Well, 10:42. That might bring us to an end to today's session. I would sincerely like to thank Catherine Birch of the ANZ, and of course all of our industry and technical experts for today's insights. You can find Catherine's presentation plus all of the key industry insights presented today on our amazing new look website, sw-au.com. But before you shut down your screens and get back to your day, it'd be a crime if I didn't thank the SW marketing team, led by the always energetic Amanda Lee. Thanks, team. Great job. On behalf of the SW team, I do hope the budget delivered some reasonable, if not good news. I hope and trust that we're able to provide a useful, pragmatic and sensible analysis of last night's announcements. Thanks for your attendance. Please check out the content on the federal budget and other news and topics on our website, sw-au.com. Thanks and have a great day.